Hi, it's Dre Griggs of the Obsidian Wisdom. Today we answer the question, where should I put my money during a recession? When it comes to investing, there are different strategies you're going to implement, and it depends a lot on the season or the time that we're going through in our economy. There are stocks that perform well when the economy is doing well. There are stocks that perform best when the economy is not doing as good. A good place to start when it comes to creating your portfolio during a recession is you want to see what industries are going to be performing best, what sectors should be performing best in a recession. For example, you'll find that Walmart does really well during recessions, and that goes for a lot of grocery store chains. Whenever you're dealing with a recession, people still got to eat, people still got to drink, and generally people are going to look for lower price options. So Walmart usually does really well. Most of the things that Walmart sells are things that people are going to be buying anyways. And then when you have less money or the economy is doing a little bit tighter, let's say your income has gone down because you were laid off or something of that nature, if you just think of it from the behavioral aspect of an economy, then people are going to spend more of their money at Walmart because their money is going to go a lot further. This is true also when it comes to stocks like Home Depot. Home Depot and Lowe's and different companies, they usually do really well during the recession because people aren't interested in paying for certain services, but they still have things that need to be done. So in a consumer's mind during a recession, you're not going to be spending $10,000, $15,000 to get your floor redone, but maybe you'll spend $3,000 trying to do it yourself. You may not spend $5,000, $6,000, $10,000 to have new cabinets put in your kitchen, but maybe you could figure out how to do it for half that price on your own by getting it done with a handyman in your neighborhood or your next door app, and then going to Home Depot to get the rest of the supplies. If you think about recessions as in what would human behavior look like, what type of decisions would I make or do I see people make during a recession, you're then able to decide what stocks or what industries make really good sense. So Home Depot is going to be really good. Grocery stores are going to be really good. You'll also see that the healthcare industry is also a good place to invest when you're dealing with a recession. When you talk about biotechs and pharmaceuticals, those companies do really well in recessions because people still have to take care of themselves. People still want a certain quality of life that they can maintain and a certain health that they expect of themselves. So we figure out ways to be able to cut in other places so we can still go to the doctor if we need to. You'll notice in these different stocks and industries that we're able to choose them or at least understand what would make the most sense as an industry based on human behavior during certain economic times. We know that when things are going really well, that people are going to travel more. They have more money, so they have more disposable income, and they want to enjoy life and create experiences. We know that when recessions come and financial concern starts to rise and people are uncertain about their financial future, they usually take a step back from trips. You're not going to be booking your cruises on Carnival. So you may want to look at different hotels and hospitality industry and sector as a whole, and you may say, this isn't the place for me to put my money during a recession. That when people start trying to tighten their budget, that is going to be one of the first things that have to go. You also can look at what is causing the recession when you're deciding what sector is going to be most benefited by it. So for example, we just got out of the COVID and that was like a very small, but it was a recession. And if you look back at that, what was it that people weren't able to do? People weren't able to go out to restaurants. People weren't able to drive. So then oil prices went down and restaurant industry started going down. So you would say, okay, this recession is being driven by people's inability to go out and spend money. So that would be places that I would end up leaving. It doesn't make sense for me to stay in the food and beverage industry because people aren't allowed to go to restaurants. It wouldn't make sense for me to be invested in the traveling industry because people aren't allowed to travel either. Or airlines because nobody's flying in planes because they can't go anywhere. Do you sort of get what I'm saying? There's certain things that are driving the recession, and as a result, you can use that human behavior to decide what industry makes the most sense. On the same token, you would notice that the healthcare industry went really well because we were dealing with COVID-19. As a result, we had different vaccines that were coming out, and the companies that were making the vaccines were going to make billions of dollars in a very short amount of time. So if you were able to invest in those industries, then you probably did really well during the recession. On the same token, who would benefit the most from us being stuck indoors, dealing with COVID-19? Well, that's going to be companies like Roblox that have digital platforms where people are sitting inside so they can't really do anything. So as a result, those kids weren't outside playing, they were playing on this virtual platform. And you notice that Roblox stocks skyrocketed. They had so many users, so many kids that were looking on those platforms. You also notice that virtual platforms like Zoom also saw spikes in their stock. People weren't able to interact with each other at work anymore. They had all their meetings virtually. And as a result, people were going to Zoom and these other companies, and their user base was growing exponentially. So again, every time you look at the recession, you have to look at what is driving it. What is it that we are trying to avoid, and what are we going to do to replace that loss that we had? When it comes to COVID-19, we weren't eating out at restaurants anymore, and as a result, we were spending more time watching streaming services. So some streaming services did really well. The streaming wars started beginning because movie theater stocks were going down because you couldn't go to the movie theater, but then HBO Max and Disney Plus were taking their movies and putting them straight out on the streaming platform. And so you notice that these companies started having a really positive effect from the market. Now, it wasn't all positive for Disney because they did have the theme park and they weren't able to do anything with that. And so you have to look at the whole picture when you're deciding what's driving the recession. So I know what you're thinking. Dre, I got you. So it makes sense when we're talking about what has happened, but can you explain a little bit about where we're going? So let's take a look at the current recession that we're dealing with. What is driving it? We're not going to say that it's being driven by unemployment because unemployment is at an all-time low. We're still adding 3, 4, 500,000 jobs every single month, and people are still getting raises. Even though it's not keeping up with inflation, they are getting raises. But talking about inflation is a step in the right direction. This recession is going to be driven by inflation and the Fed's interest in reducing inflation. Inflation is at a 40-year high. The Fed has come out many times and has said we are focused on bringing down inflation at the expense of people's employment, at the expense of the economy's overall growth and GDP. We're going to get inflation under control, point blank period. So this current recession is then being driven by inflation and trying to get rid of it. So what is the Fed doing? The Fed is raising the rate to try to drive down inflation. Why does that drive down inflation? Well, I'll put a link in a video where I talk about that. But the short story is the interest rates, as they're increasing, people will borrow less. As people borrow less, then that's going to pull money out of the market. And as money's pulled out, demand is going to drive down, and then all of a sudden rates will start going down. Now, the Fed understands, because we're near full employment, that most companies have to be very competitive in what they're paying people to be able to maintain or bring in new talent. If everyone has a job that wants a job, the only way you're going to be able to drive in new talent is by paying more and more and more. So the Fed understands, as we increase rates and we drive down demand, that people are going to lose their job. And as enough people lose their job, then the demand will continue to lower until the point that inflation is gone and they're back at the 2 to 3% that they're shooting for. So when a recession is driven by inflation, most will say the finance industry is a good place to invest. As loans become more expensive, banks stand to make more money. Banks are going to make more money because the rates are higher, so they're going to charge more. And as they make more money from us with the loans, that will also tighten up credit a little bit. And so that increases the likelihood of them getting their loans paid back. Usually, they're not going to have as many bad loans on the books because most people aren't going to be approved for them based on the higher rates. People are going to say, well, I don't want to pay that much per month, and whatever the budget is. The same will happen with the houses if you really think about it. As the rates go up, all of a sudden my $1 million house that had like $1,000 payment, well, when the rates go up, my $1 million house now has a $2,000 payment. Well, if you were only budgeted for $1,000, you now can only buy half of the house that you would have bought. Now, I know the numbers aren't exact, but you get the example that I'm making. As the rates go up, you can afford less house. And as you can afford less house, that's going to cool off the housing market, which is then going to start lowering those prices down as well. So as you can see, the current recession is being driven a lot by inflation and the Fed's desire to bring down inflation. Now, a similarity between this recession and the previous ones is because inflation is so high, people are going to start spending differently. They're not going to buy the same quality of food because it's becoming so unreasonable to fit within the budget to feed everybody. And so that's going to drive people back to places like Walmart, back to places like Home Depot to fix things yourself, back to places like McDonald's where people are going to eat fast food at what will be considered a reasonable price. Consumer goods normally do pretty good, and that would be like your food and your beverages and things like that. Another interesting fact is people actually drink and smoke a lot more during a recession, whether it's the stress or they lost their job or whatever they're dealing with. People drink and smoke a significant amount more. Now, you generally won't just find a company that is only dealing with alcohol, but you'll find within the consumer goods that they are branched out in there, that you're going to find that companies like Pepsi and Coke and different companies, they are so well diversified, they usually touch a little bit of everything. They're great companies for consumer goods to look at. And so they end up being able to build their own companies or portfolios in a way that they have companies that do really well during economic growth, and they have companies that do really well during a recession and economic slowdowns. You would mirror that. During times of economic growth, you have good companies that you're very comfortable with. During times of economic slowdowns, you have good companies that you're also very comfortable with. Now, it is unlikely that any particular company is going to do well in all seasons, which is why you generally want to have your investments set up to help you during a time of recession, and then you want to have a plan for exiting and shifting them back during a time of economic growth. Many people, when they're concerned about the value of the dollar and inflation, different things, they may want to invest more in gold than other alternative investments. What I hope you're taking away from this is when you're choosing which stocks to invest in, you really have to look at human behavior and what it is that we do in a particular economy. What is it that most people are going to decide makes the most sense for them? If you find the company that is maintaining value, then you're going to find a great investment. Now, shifting from economic growth to a recession does not mean that you forego all of the normal strategies that you use. Now, you still want to be investing in companies that have long-term potential and growth, companies that you believe in, companies that manage their debt very well, companies that generally are going to be your larger companies where they're worth over $10 billion. You don't want to be taking risk on smaller companies. You want to make sure they have a good amount of cash on deck for anything that's going on that's unexpected, where they can continue investing in their R&D and making sure that they're listening to their customer, light and agile so they can pivot, where they don't have to worry about not being able to get a loan because the interest rates are going up, so the credit worthiness is becoming a bigger deal, and then they may not be able to get the money that they need to survive during a recession. You are not so focused on finding the companies that are going to do best in a recession that you forego all of the analysis that you would normally perform on a stock and choosing a company. If you are not someone who likes performing the stocks and the analysis, then of course I invite you to check out Obsidian Wisdom and go to obsidianwisdom.com, and then you can schedule a complimentary financial plan appointment and we can put something together for you. Or you can go and look up index funds in any industry. You can put in consumer goods index fund and you'll find one that's based on that. If you feel that gold is a great place and other alternative investments, then you can put in precious metals index funds. You can put in real estate index funds. You can find an index fund or an ETF that is designed for each of these sectors and industries where you can invest in them as a whole and then just ride whatever that wave is, however you're comfortable with it, would be the best decision. But do not make short-term decisions with your long-term money, right? You got to make long-term decisions with your long-term money. And that always means that we need to first evaluate the worthiness of the company, cash on hand, leadership, the vision, whether they're providing value and a good service. And then we go to the human behavior and we start analyzing where we think people are going and they're spending their money. Where would they cut based on this particular recession? And where would they go with that money based on this particular recession? You always start with the basics. If you like the video, I ask you to like and subscribe, and feel free to check out other Wisdometric videos if you're looking for ways to eradicate financial stress, generate passive income, and build a prosperous retirement strategy.